Hey, what's up guys? Welcome to the video today. What's going on? We're going to talk about options risk management, risk considerations for options trading. All right, options trading is a lot more technical than just stock trading because there are derivative contracts from the underlyings, okay? I'm going to be using some references from this book right here, which is Option Volatility and Pricing. This is the Market Maker Bible. And I'm going to be using some references from that book, but also just some examples of practical experience and things that you need to be aware of managing risk in options trading. Okay, so first things first, when you are trading an underlying contract, the only thing that poses you a risk is the directional risk. So if you buy it and it goes up, you make a profit. If it goes down, you make a loss, right? But with option contracts, there are other factors that come into play when it comes to risk management, okay? And we'll talk about those things real quick. So the things that move option prices, they call them the Greeks. These are the parameters from which the option contracts values are based on, okay? Option prices can vary quite a bit, and there are many factors that can play into the pricing of option contract. One of the main ones being volatility. So whatever the market is forecasting for volatility, aka the VIX, that plays into the option premiums. Next is how much time to expiry, so the theta, and then you have the directional risk associated with the contract, aka the delta, and the gamma, which is the acceleration of that delta. So as you can see, there are many more factors involved with the risk of these contracts. Last but not least, there are also interest rates that affect the prices of longer term option contracts, okay? But if you're trading shorter term option contracts, that is not a worry to you. So this video is going to be to give you a general understanding of options risk management, and after, I expect you to go and do some homework and master it yourself, all right? So I'm not going to go into deep nitty-gritty of crazy math formulas because you can absolutely do that with options trading. So the delta. Now, the delta is basically the directional risk of the contract you're trading against the underlying contract. This is a screenshot of an options chain. And you can see here the current underlying price is between 289 and 288. Just for quick, you're going to see these Greeks on the top here: delta, gamma, vega, and theta. Let's concentrate on delta for now. Okay, so we're going to look at the call option side here. The contract is currently trading between 288 and 289. So you can see that these options here would be considered at the money. And you can see that their deltas vary around a 50 point, okay? Which means that for every 1 point in the underlying contract, this option contract is going to move by the amount of delta there is there. The value of that contract should theoretically increase by the delta. Now, it's a little bit more complicated than that, and we'll get into it after in a later part in the video. Because as we know, deltas are not static, so which means they don't stay the same. So for example, if you're trying to risk, I don't know, 50 cents in a stock, so that means that you're going to be risking half of this delta. If you want to buy one contract, you're risking 50 cents in the stock, which is half a point. So that means you'd be risking half of that delta. But let me tell you why it's not that easy to measure directional risk, because there's gamma also. So gamma is the rate of change of delta, which means that when this contract moves up or down a certain amount, the delta will not be 56 anymore. It will have changed to something else. So that's why you need to understand some basic math to determine the average delta over a range of prices. And that's, I think, a more useful risk management tool than just the delta and the gamma on its own. I'm referencing Sheldon Natenberg on that one. All right, next one is the gamma. Gamma is the rate of change of delta. Another way to categorize gamma is by the speed of the market, okay? So if you're long a contract, any contract, a call or a put, you are essentially long delta and you're long gamma. The closer to expiry the contract is, the more gamma there is, depending on if it's at the money or not, okay? So you can end up with huge profits with option contracts if you buy out of the money and they end up becoming in the money. Also, you can end up with huge losses if you sell out of the money and then they end up being in the money. So generally, gamma is the speed at which the options delta will change. Gamma is the highest for the at the money options approaching expiry, because those are the ones that have the most directional risk, because the deltas go from being 0 to 100 real quick approaching expiry. Gamma is important to consider because it adds a strong directional risk in trading options that are closer to expiry. We're going to get into some specific examples later in the video. I'm just going to keep going through the risk factors here. The next one is the Vega. The Vega is the options exposure to changes in volatility. So whatever number you see in the Vega column here is going to be the amount the options price changes up or down for a 1% change in volatility of the underlying contract. So you can see up here in the corner, this is an options chain from IBKR. You'll see that the current implied volatility for this contract's expiry, which is 1 day to expiry, is 1.7%, which means that these at the money options here are implying a 1.7% move in the underlying contract. That is what they are currently implying based on annualized implied volatility. All right, you can use annualized implied volatility to measure daily risk of contracts as well. Let's talk about Vega real quick. So again, Vega is the volatility exposure that the contract has. Vega plays in more to contracts that are later dated expiry. So if your contracts are shorter term expiry, they're not going to have a high Vega. Consider this. Vega is highest for options that are at the money and further away from expiry. And I think that is why option traders who trade 1 month out or 2 months out, they prefer to sell options when option volatility is high because they have that Vega in their edge. If you've had an extreme increase in volatility, we know that most of the time volatility doesn't stay high for a long time. So if you sell out 1 month, 2 months premium when volatility is spiking, then you have an edge that when volatility declines, those contract premiums are also going to decline considerably as well. So Vega plays into later dated expiries and has the most at the money options. So even shorter term expiry, 1 days to 3 days to expiry, they will also have considerable Vega exposure, but mostly around the at the money strikes. You can see that the out of the money strikes here don't have a lot of Vega exposure. All right, so that's Vega. It's very important to understand for certain option strategies. The next is the Theta. This is going to be the last one for now. So the Theta is simply the time value associated with the price of that contract. If the contract is trading out of the money, then it's assumed to be 100% time value, right? So if SPY is trading at 288, then these calls, all of these calls right here, they're priced at a 1.5% vol. All they have is time value and implied volatility in them. So this is Theta right here. So these numbers that are displayed on Theta are always going to be a negative number because when you buy an option, it will always have a time value component associated with it. When you see here minus 0.75, it means that every 24 hours that passes, this contract, considering the fact that the underlying will not change price, this contract will decay at 75 cents a day, and in dollars it's $75 a day, okay? So that's per 24 hours, and it also applies to weekends and holidays. Keep in mind. All right, so Theta is very important. So when you have a position or a portfolio, you need to understand where your risks are in all of these categories. What kind of delta are you having for your portfolio? The gamma risk associated with your portfolio, the Vega and Theta risk associated with your portfolio, if you're holding positions overnight or not. Now, generally, if you're a market maker, usually they try to stay somewhat delta neutral in some cases, because someone comes in and buys $1 million worth of call options, then the market maker who sold them those call options is now going to have to hedge himself by buying stock in the underlying or selling puts in the underlying to keep himself relatively delta neutral. Now, obviously, they don't keep themselves 100% delta neutral all the time. It's just a concept that needs to be understood. Okay, so we've talked about the main factors here associated with the prices of these options. Now, one thing I'm going to talk about real quick is liquidity. So when you're trading options short term, like if you've watched my other videos, you need to make sure you are trading options with the highest liquidity, which means there is volume being traded right now, and there is open interest in the market, and there is a tight enough bid and ask spread so that you can potentially make a profit, and that you will likely find someone to sell it to once you're in profit. So that's what liquidity is. You do not want to find yourself trading option contracts that are not trading any volume on the day or have no open interest on the day, especially if you're short-term trading, okay? Generally, if you look at the majority of option contracts on the S&P 500 or the NASDAQ or any big tech names, you should have a lot of liquidity on all of the at the money and all of the out of the money strikes up to 1.5 standard deviations. You can see here, so these yellows are 1 standard deviation. This is 2 standard deviations away from the current trading price. And you can see that they are still having a lot of volume there on those 2 standard deviation strikes. So if you're trading spiders or NASDAQ, you should generally always have a lot of option liquidity to work with. So that is not going to be a problem. But it will be a problem if you suddenly decide to buy a call on an illiquidly traded stock. So just be careful with that. And that's why I stick to trading the same thing all the time. Let me take a sip of my coffee. All right, so let's talk about directional risk in the underlying stock you're trading. I'm going to give you a hypothetical trade, and we're going to try to understand directional risk for option contracts right now, okay? So I'll give you an example of a trade on the Qs here. So let's say I want to take a long trade here. The current trading price is 238.22. I'm going to need to identify where my risk is. So let's say if I take a long trade here, I'm going to buy a call or sell a put, and I'm going to keep a stop underneath these lows by a certain amount of ticks. So the lows here is 237.64. So let's say I kept a stop 11 ticks below that low. So 237.53 would be my stop. Now we need to understand the directional risk associated with our position to where our stop loss is going to be. So if we enter at 238.22 to 237.53, the directional risk would be approximately 70 ticks in the underlying, okay? So that's our general guideline. We now know that our risk in the underlying is 70 ticks. So now that you understand your directional risk, you can now go into the options market to figure out which option you will trade that fits your risk tolerance and how many contracts you're going to be trading. This is a different options chain. It's not the options chain of the Qs. So let's say I wanted to risk between $10 and $20 per contract on this trade. Remember, my risk on the underlying contract is 70 ticks, so 70 cents. So this delta number here is for a 1 point move in the stock, so 100 ticks. So that means that it's about 3/4 of a delta that I'm going to be using here, because it's about 70 ticks. So let's say I go to this option right here. It's slightly out of the money. It has a 21 delta. 3/4 of that is approximately 16 or so. And again, I'm approximating, which means that if we buy one of these contracts right now with the 70 tick risk in your trade from your entry point to your stop loss point, then theoretically you will be risking approximately $15 a contract. Like I just finished telling you earlier, these deltas are not static, which means they don't stay the same based on where the stock is trading. So this 21 delta, if the stock moves up, is now going to be a 23 delta or 24, for example, okay? So I'm just rounding it off and getting about 3/4 worth of that delta. From my point of entry to my point of exit, I would be risking approximately $16 to $17 a contract, assuming that this delta stays at this price right here. You can repeat the part of the video if you didn't understand it, okay? So again, according to Sheldon Napeberg here, this, what I just mentioned to you, assumes that the delta is constant, which it is not. As the underlying price moves from point 1 to point 2, the delta of the option is also changing. So having understood that delta is not constant, there needs to be a way to measure the average delta over a series of prices. So to make this nice and simple, we're going to assume an underlying price move of 100 ticks. So 1 point, just to make it a little bit simpler. So from before, we established that our delta for this contract is 21.8 and the gamma is going to be 7, which means that right where this contract is currently trading now, if the contract moves up by 100 ticks, the delta is not going to still be at 21.8. The new delta is going to be this delta plus this gamma. So let's do some basic math here just to show you, okay? So we're gonna start off by adding the delta 21.8. We're gonna add the gamma to this delta. So this would be the new delta once the contract has moved up by 100 ticks. Okay. Let me tell you why this delta is still not a great indication of your actual risk in the contract. So what we will do is we will now add together the two deltas and then divide them by 2 to figure out the average delta over a range of prices. Now we have 0.288. We're going to add 0.218 and it will equal 50. Divide that number by 2 and we will now see that our average delta over the price range move of 1 point is 0.25, and that includes the gamma. All right, so that's how you measure your average directional risk over a series of prices. So that's a basic example, and definitely you can get a little bit more complex if you're measuring more risk. So I'm going to be using this exercise to improve my risk management with my options trading. Cool. All right, just a few quick notes before we finish the video here. Now that I've blown up your brain with a whole bunch of options terminology, you need to understand a few key concepts here. So let's make some statements about all of the risk factors I just mentioned. Let's say this real quick. So the gamma, vega, and theta of an option will always be highest on the at the money options. So the options trading at the money or near the current trading price will always have the highest theta, vega, and gamma. And now these things will change depending on how close the expiry date is. The closer to expiry, the higher the theta and the higher the gamma. The further from expiry, the higher the Vega and the lower the gamma, the lower the theta. So you just need to understand that. So the closer to expiry we get, the more directional risk we get in terms of how fast the market can move. So again, gamma being the speed of the market, theta can be considered the opposite of gamma, because when an option is at the money, it has the highest theta and highest gamma. But if the option now moves into the money, the theta will decrease because it is now starting to have intrinsic value. The gamma will decrease because, as we know, the maximum delta is 100. So as you can see here, these gammas are high at the money, and then as the contracts trade in the money, the gammas slowly start to decrease as the delta gets closer to 100. Just some quick pointers for you guys to help you manage your risk. I hope you can use the directional example to your advantage and do your homework for options. If you're interested in this stuff, take your time, because we know that it is very easy to lose money trading options if you do not know what you're doing. I have about 1 year and 8 months experience of trading options at this point. I can consider myself somewhat experienced with options trading, and I'm still losing money. Don't jump into this game too fast. You need to really take your time to understand it, one step at a time. Be patient, guys. I wish you all a fantastic day. Hope you enjoyed the video. Take care. Bye.